Hello, I'm William de Gale. I'm the lead portfolio manager for the BlueBox Global Technology Fund. For 20 years, I was at BlackRock investing in technology stocks. I ran BlackRock's offshore global technology fund for almost 10 years. But in 2017, I left BlackRock and partnered with a multifamily office based in Geneva called BlueBox Wealth Management to essentially recreate that technology strategy, initially for family offices and now for a broader investor base. And so we launched the BlueBox Global Technology Fund at the end of March 2018. And within 3 years, we'd taken AUM to more than $450 million, which is quite an achievement for a completely new investment firm. And the reason we managed to achieve that is that what we were doing has been very different from what everybody else does in the technology sector. And this has proved to be successful. In that we have outperformed our peers and benchmarks. So on this slide, I've summarized the 5 things on the left that most technology investors do most of the time. And on the right, I've set out what we do, and it's pretty much the opposite all the way down the list. And in the presentation, I'm going to go through each of these 5 in turn, but just to sort of run through them quickly together. The first one is constant change. Everybody assumes that because the technology sector is always changing, there's always something new, that tech funds have to be constantly changing as well. So they are. They've typically got very high turnover, well over 100% a year, as they're always chasing the latest story and trying to get ahead of the news flow. It's very difficult to outperform, though, if you've got high turnover. And we'd much rather have low turnover, ours is typically around 30% a year, and long-term ownership. So I've owned some of these stocks for more than 15 years now. The second point is the sort of companies that we're buying. Because everybody in the tech sector is obsessed with disruption and the disruptors. Now, disruptors are very exciting companies. They're companies that are using technology normally to sell something other than tech. So they're not tech companies, they're users of technology. But they're using that technology in a new way to disrupt the industry that they're in. They are very exciting, they grow very fast. We often use their products. They're in all the newspapers. And as businesses, they're often absolutely dreadful, awful businesses. And we'd much rather focus on the enablers. These are the technology companies that make all that disruption and a lot of other stuff possible. And those are very attractive businesses indeed. So that's what we prefer to focus on. And we're not really interested in the disruptors. The third point is quite similar, that everybody is obsessed with ultra high revenue growth companies. And actually, there's some fairly clear reasons why you should just avoid all of them. So that's pretty much what we do. The fourth point is that profits are now largely regarded as optional in the technology sector. They can always be postponed, probably forever. And we think that that is essentially a fundamental misunderstanding of what investment is about. We want our companies to be profitable, extremely profitable, now. So we might wait until next year, but we're certainly not going to wait many years for some fictional adjusted profit that's probably never going to appear. So we want our companies to be extremely profitable today. And the final point is a matter of size. So to me, a mega cap in the tech sector has a market cap that's more than 1% of the S&P 500. That's currently around $350 billion. And there are 13 tech-related mega caps in the world, and they dominate almost all passive and active technology funds. And that's just missing the sweet spot of the market, because we think the $10 to $100 billion market cap range is the most interesting bit of the tech sector. And that's where we have typically between 1/2 and 2/3 of our assets invested. And the result of the 5 on the left is that most technology funds underperform most technology benchmarks in most years. But no one really notices, because in absolute terms, they've been doing rather well. So if your tech investment is up, say, 30, 31, 32% a year after fees over the last 3 years, you might think that that's pretty satisfactory. But in reality, I'm afraid, over the last 3 years, to the end of December 2021, that's underperforming an industry that's up 37, 38, 39% a year over that period. But of course, the fund manager is not going to draw your attention to that underperformance. So they'll do things like change the benchmark. They'll add telecom and media stocks in, which make it a lot easier to beat. Or they'll compare themselves not to the industry or a benchmark, but to other technology funds, none of whom are beating the benchmark either. Or they'll give themselves a quartile rank against all equity funds or all global funds. But at the moment, if you're a tech manager and you're not in the top decile of all equity funds, you're simply not doing your job properly. So none of them are particularly fair comparisons. Now you can see from the number on the right that our fund to the end of December 2021 was well ahead of the toughest version of the broadest global tech benchmark. And then you can see that according to Bloomberg, compared to offshore IT funds, we were first quartile in 2019, 2020, and 2021. And the result of that is that we were actually, according to Bloomberg, in the second percentile of all offshore tech funds for the 3 years to the end of December. And according to Citywire, we're first decile for the first 3 years from inception and the 3 years to the end of August. And the net return annualized of the fund since its launch at 30.3%. Well, that's not sustainable. I cannot possibly claim we can keep up a 30% annualized return. But the next number down, the 17.8%, so that's the average annual return after fees of this strategy over the last 10 years, first at BlackRock and then at BlueBox. And that number, when I've calculated, has always been between 14 and 20%. And that mid to high teens annualized net return is what we think we can maintain as a long-term return on this strategy into the future. And I'll explain why in the presentation. And that's how we got the fund to AUM in excess of 1.1 billion within 4 years of launch. We're doing something very different from other technology investors. It makes sense to people when we explain it, and it clearly works better than almost every other tech strategy out there. So let's go through those one at a time. The first one, low turnover. So how can we outperform an ever-changing industry with a portfolio that doesn't change very much? And the answer is that we've thought about what's going on. So this slide shows that the technology sector in blue has been outperforming the broader market in grey almost without a break for 10 years. And everybody just seems to assume this is what should happen. But the technology sector has no right to outperform. There's no reason why the technology sector should outperform the broader market for 10 years in a row. But no one is asking the question, why is this happening? Why is it happening now? Why was it not happening 10 years ago? Will it happen in the next 10 years? So we think there's a fairly clear immediate explanation for why technology has done so well. And this is, in my view, the most important chart in all equities. This is the total incremental operating profit of the entire S&P 500. So all US large cap companies added together. But it's the incremental profit since the end of 2009. So all the profits before 2009 are off the bottom of the chart. And it's divided into technology in blue and everything else in grey. And what you can immediately see is that the grey, the vast majority of the market, the non-tech sectors, have not seen any collective profit growth since the end of 2009. So that's 11 years without profit growth. So profits went up. They didn't go up very much. So from the end of the recovery from the financial crisis, so the beginning of 2011 to before COVID at the end of 2019, that's only 2% a year annual growth, so much the same as the rate of inflation. And then even that growth was then very suddenly lost with COVID. And yet, over that period, the tech sector has grown its operating profits by around 12% a year. And that immediately explains the previous chart. If technology had not outperformed the market, where it is responsible for 100% of the growth of operating profits, it would be very odd indeed. But it makes two further questions arise. First of all, why is this happening? Because this is very abnormal. This simply should not happen with one sector dominating profit growth for such a long period of time. And secondly, does it continue? Because if it does continue, then technology will continue to outperform the market. And so we think there is a reason that we can see why this is happening. And it's something that changed in the way that technology operates from around 2005 onwards. So just before the beginning of this chart, the way that technology operates changed in a fundamental way, and that has led to this total domination of profit growth by a single sector. So on this slide, there are two images which demonstrate what that change is. They are both of the same bridge in Berlin at the same time, early on a Sunday morning. And you can see from Google Maps on the left that there is very heavy, probably stationary traffic on that bridge because it's coloured dark red. But you can see from the photograph on the right that actually there were apparently no cars on the bridge at all, just one gentleman walking down the middle of the road. So what is going on? How has Google got it so wrong on this occasion? Because we know actually this normally works pretty well. How does Google generate that traffic information? Are the people standing on top of that office block on the right with binoculars watching the traffic? No, clearly not. But maybe there are cameras on those lampposts on the left, and there are screens back in an office showing all the roads in Berlin with people watching them. But no, you couldn't scale that either. It's completely impractical. So Google achieves this traffic data by watching the movement of mobile phones. So if you have lots of mobile phones all traveling down a road in the same direction at roughly the same speed, and then they all slow down and then come to a halt in roughly the same place, Google makes the reasonable assumption that what you have there is heavy traffic that has then become stationary, and it colours the road first yellow and then red. So why is this not working? What's wrong with the photograph on the right? So the reason it's not working is because the gentleman walking down the middle of the road is a performance artist, and in his trolley he has 99 mobile phones and they are all switched on. So Google makes the reasonable assumption, because there are lots of mobile phones all moving very slowly together, that there's traffic jam there. So it colours the road red. But if there was a human being watching, either in person or through cameras and screens, they would immediately see through this. They would colour the road green. They might not know what was going on, but they'd know that traffic could flow freely, so it would be coloured green, not red. But there are no human beings. The human beings have been taken out of the loop. And that works very, very well almost the whole time. This is the model of computing in the 20th century. A computer is a digital creature. It has no understanding of the real world, the analog world of continuous variables that we live in. So a human being would have to translate, typically with a keyboard, an analog problem into a digital question that the computer could understand. The computer would then do something very clever and produce a digital result on a screen, on a printout, and a human being would read that. And then we, the humans, would act on the world. So we were the input and output device for the system, translating analog to digital, then digital to analog, and then acting. But that began to change from around 2005. So this shows you the new model of computing. The computer has come out of its box and begun to interact directly with the real world. So the Internet of Things, sensors, mixed signal, analog semiconductors, they allow the system to know something about what is going on in the world. And they know it directly. There's no human being with a keyboard involved anymore. And at the other end, increasingly, the system is acting directly on the world. Automation, robotics, the system is not suggesting to a human being what to do. It's just doing it. It's changing the world itself. So we, the humans, have set up the system, but then we step back and just supervise it. We've taken ourselves out of the loop. And if you take human beings out of the loop, then processes run millions of times faster, because we were by far the slowest bit of that system. And if processes can run millions of times faster, then hundreds of times more applications become viable. Things that were simply impossible in 2000 are now just very difficult indeed. And the technology sector is all about very difficult indeed. That's what the sector does. And this brake has been taken off all of technology at the same time. And it lies behind everything that is exciting in technology today. And there is a lot, there's more exciting in technology at the moment than at any point in our lives. There really is, it's not just imagining it. So let's give a couple of examples. So on this slide, on the left, you'll see the Nintendo Wii. So if you are a games player and you bought yourself a Nintendo Wii when it came out at the end of 2006, you had a completely new playing experience. Because up until then, playing a games console, you held a games controller in your hand. It had two levers and lots of little buttons. And you used those levers and buttons to interpret what you wanted to happen on the screen. But with the Wii, if you wanted to play tennis like these two ladies, you just picked up the controller and you swung it like a tennis racket. Totally new playing experience. So how did the cheapest of the three games consoles transform the games playing experience? The system knew something about the world. It knew where that controller was, how it was oriented, and which direction it was traveling in. And that was enough for you to put topspin or backspin on the ball. Dramatic change in the way you played games. And it's all because the system knew something about the world, and then it changed the world on the screen in a very small way as a result, without further human intervention. Well, on the right, Uber. So what's the difference between Uber and a traditional taxi service? So with the traditional taxi, you wanted to lift somewhere, so you phoned the taxi office. And someone with a headset on took the call, found out where you were, where you wanted to go. Then they phoned a driver, found out where he was, how long it would take him to get to you. They would work out how much to charge you. That person would then phone you back. And then suddenly the whole system could start working. But with Uber, you have a mobile phone in your pocket. It knows exactly where you are. The driver has a mobile phone in his car. It knows exactly where he is. You tell your phone where you want to go. And that's all you have to do. That's all the information the system needs. There is no one with a headset involved. The human being has been taken out of the loop. And it's that removal of the human being from the loop which is the fundamental difference between Uber and every existing taxi service before it. And this is true of everything that's exciting in technology at the moment. Every single thing that's dramatically changing as a result of technology in our lives currently depends upon this direct connection of systems and the real world. And on this slide, you can see a fairly dramatic effect that it's having. It's basically turning technology from being an industry vertical like insurance and telecom and retail into an economic horizontal. So in every other industry, the company that is winning is the one that has worked out how to use technology to disrupt its industry. Then all its competitors have to copy it, and from then on, that new use of technology simply becomes a cost of doing business. In effect, every company in every other sector is now having to spend all the money they can on technology because that is the differentiating factor in business. So they are spending their excess returns on technology. And if you don't reinvest your excess returns in your own business, you don't grow. And that explains the chart 5 slides back. All the grey companies, the non-tech companies, are investing all their excess returns in technology in the blue. So only technology is growing. And it's not going to stop anytime soon because these big changes in technology take decades to work their way through the system. An application is derived from this, and it then enables a whole range of new applications, and each of those in turn new applications again. So you get first, second, third, fourth, fifth order effects, and that takes a very long time to work its way through the system. So we are still at the beginning of this change. And this slide shows you that from an investor's point of view, this makes life a lot easier. Because rather than jumping from one hot theme to another, as most tech investors are doing most of the time, we see each of them as either enabled by or aspects of direct connection. So we focus on those companies, on the ones that are enabling or supporting direct connection, which are allowing those disruptive businesses to do what they want to disrupt. And we focus on those enabling companies because they don't change. They do it again and again and again for different disruptors. And the nice thing is that gives us exposure not just to whatever is hot and exciting and growing today, but also what comes next. So whatever the hot technology idea of next year is, the companies that are quietly making it happen in Silicon Valley at the moment are having to connect their systems to the real world, or they wouldn't be able to make it work. So they're already buying stuff from our companies, and we haven't even heard about them yet. And that brings us now, in this slide, on to the next question. Why would we want to avoid those disruptors? So this slide shows you the message that you'll get now if you've got a package coming to you from DPD, the shipping company, this afternoon. It tells you that Kevin is going to deliver your package at a certain time. So you stay at home for that extra half an hour, and it means you get the package and Kevin doesn't need to come back tomorrow. Fantastic. Everyone's a winner. It's a brilliant innovation, potentially disruptive. So do you buy DPD, or the German post office who own it, in order to get exposure to the disruptor? And here you see, no, you don't, because it's not very difficult. So once one company has done it, they all do it. And it just becomes a cost of doing business. Because now, if you're a shipping company and you don't offer this service, you won't get any new orders because everybody expects this of you now. So there's no point in buying either the disruptor or the fast followers, because none of them are now getting a competitive advantage. It's just a cost of doing business. So as an investor, how do you get exposure to this disruptive innovation? And the answer is EPAM. So EPAM is a software services company. It basically creates sophisticated software for companies that can't do it in-house. That's almost any company. 40% of its clients are other tech stocks. And what it is doing again and again is essentially the same thing. It is connecting traditional products and services to the real world. So in the industry, this is called digitization or digital transformation. But for me, it's direct connection of traditional products and services to the real world. And here are some examples of things they've done recently. So the first one is one of those shippers' notification systems, which we just looked at. The next one is they rewrote the software for an oil refinery so that it could be upgraded without shutting the refinery down, which takes weeks. And the third one is they created a new wealth management system for UBS. This allows the UBS wealth manager, when he's speaking to a client on the phone, to know everything about that client and every possible investment they might be interested in on a single dashboard without having to pull that data from various different applications. Fourth one is they work with a pharmaceutical company to develop new drug discovery and development process. And then finally, they've been working with Epic for years to scale Fortnite to 350 million players. Each of these is a potentially disruptive innovation. But do I want to own the disruptor? Do I want to own a shipping company? No, probably not. That's pretty boring stocks. Do I want to own an oil refinery? I don't think so. I suspect they're on a downward slope for the rest of our careers. Do I want to own a Swiss bank? Absolutely not. Dreadful business model for investors. Do I want to own a pharmaceutical company? Well, maybe, but I'd probably pick the wrong one because I don't know much about them. Would I like to own Epic? Well, yes, but it's a private company, so I can't. So I either don't want to or can't own these disruptive companies, but I can own EPAM. And EPAM is essentially doing the same thing for company after company in a huge range of different end markets and industries. And that is a great business model for an IT services company. It's doing the same thing again and again for different clients. And you can see the impact on its revenue and, even more importantly, on its earnings per share in the bottom right. This is a very well-run business. It translates that revenue growth into profits for outside shareholders. And this has taken the stock from $12 at the IPO when I bought it in 2012 to around $400 today. So up until the beginning of 2020, this stock, EPAM, had outperformed Tesla. But does anybody ever talk to you about EPAM? No, because it's boring. Does anybody ever talk to you about Tesla? Yes, the whole time, because Tesla is exciting. It's a disruptor. It's changing the world. It's changing its industry. It makes beautiful cars. They go a very long way on a single charge. They hopefully won't fall apart too soon. Everybody wants to talk about Tesla. Everybody wants a part of it. People want it in their portfolios. EPAM, in contrast, is boring. No one wants to talk about it. No one even thinks about owning it. Tesla is not very profitable. It might make a profit with the right colour rosy glasses on, but generally you'd see it as a not particularly profitable business. EPAM, in contrast, is a phenomenally profitable business. And that's what makes it a very good stock. And this is the key differentiator. Disruptors. Disruptors don't make money. They spend money. That's what disruptors do. They spend money. And in contrast, enablers are the businesses that make the money. And then even worse, disruptors disrupt only once, and then generally they are disrupted in their turn. So you've got to own them for a very specific period in their life cycle to get the upside. But enablers do it again and again and again for a huge range of disruptors, often in completely different industries and markets. So of the two, I would much rather own the enabler. It's the one that makes the money, and it goes on making the money for years. So avoid disruptors and focus on enablers, but no one else is really doing that. And on this chart, you can see the impact of this on the market and on profitability. So this is Goldman Sachs' version of my chart early on, and this one goes back a lot further in time. And the pale blue line are the total profits of all large cap US tech companies added together. And the dark blue line are the profits of all the world's non-tech companies added together. And what you immediately see is that since 2007, there has been no growth for non-technology companies in the world collectively. That's 14 years of zero growth in profits for the vast majority of the world's companies all added together. But in that time, the tech sector has seen its profits more than quadruple. So what is going on here? Let's think about Tesla again. Where does Tesla feature on this chart? Is Tesla a tech company? No, it's an auto company, so it's a consumer discretionary. So it's in the dark blue line with everybody else. So what happens when Tesla enters the auto industry? Up until now, Volkswagen has been very profitable. But suddenly, Volkswagen has to invest all the money it can in developing, building, and then selling at a loss electric vehicles. So the profits of Volkswagen and all the other existing players in the market collapse. But Tesla isn't making any money either. So the total profitability of the auto industry goes downhill, it's destroyed. But what are these companies spending all this money on? They're spending it on electric vehicles, on technology. So the profits of the technology industry soar because that's where the money is being spent. So the disruptors are not the companies that make money, they're the companies that spend the money, and they also destroy the profits of the businesses around them. So the impact on the industries is to collapse the profits of those industries, and those profits go instead to the tech companies that are enabling that disruption, which everybody is now having to spend all the money they can find on. And so if people ask me, is there a technology bubble? again and again and again. Isn't there a technology bubble? It's a technology bubble just like 2000. There isn't a bubble in technology. The bubble is everywhere else. So the bubble is in the dark blue companies. These businesses have not grown their profits collectively for 14 years, and yet MSCI World in that time is up by more than 100%. So if you're looking for a bubble, it's in either the disruptors or the companies that are being disrupted by them, or probably both. So the incumbents who are being disrupted are seeing their profits collapse, and it may well be they're not worth anything at all now. So they're overvalued. And the disruptors coming in aren't inherently profitable businesses either in many cases. So they're probably not worth very much either, but they have hugely inflated valuations in the market. So the total valuation of these disruptive industries, if you add the disruptors and the companies being disrupted together, is increasing over time, even though the profits of those industries are actually going down. So they are becoming more and more expensive. The bubble isn't in technology, it's in the rest of the market. The tech stocks have seen their profits collectively grow by around 15%, which is what this chart shows, which is almost precisely in line with the movement of the average tech stocks price since 2009. So now we move on to ultra high growth. Why would you not want to own a company that is growing 200% a year? And on this slide, you see there are 4 good reasons. And the first one is, if it's growing at 200%, the chances are that growth is going to slow down. It can't go on. And predicting when that happens is very difficult. And if you own the stock when that growth starts to slow sharply, you're in trouble because there's no valuation support for it. So it will collapse. So owning very, very high growth stocks is very risky. The penalties are extremely high and they are unpredictable. The second point is that companies that are built for growth aren't built for profit. Let's think about WeWork. So WeWork, right from the start, was designed with the aim of growing as fast as possible so that it could attract the attention of venture capitalists. And it was very, very successful. It got a lot of venture capital money in, and then it forgot to grow up. In fact, even worse than that, it was told not to grow up. So SoftBank's Vision Fund arrives and says, here's another $1 billion. You can have it as long as every decision you make for the next few years is focused entirely on growth, whatever the cost. So the economics of every decision are completely ignored. And once you've had a company that has been run like that for a number of years, it is almost impossible to turn it into an inherently profitable business. You might be able to fake a profit for a couple of quarters, even a year or two if you're lucky, but it will never be an inherently profitable business. It's just too late. So companies that are built for growth aren't built for profit. The third point is that they are just very, very obvious. So I can build you a screen in a few seconds on Bloomberg. We'll show you every single listed stock in the world that's growing more than 75% a year. They're obvious and therefore they're expensive. And then the fourth point is the nicest of all, and that is there are always more of these companies going down than going up. So last year, 2020, Tesla was a phenomenally successful stock. We didn't own it in the portfolio. We don't care because we didn't own the phenomenally profitable or successful stock from the year before or the year before or the year before, and they're all going down. So if you own none of these companies, you're already ahead of the benchmark because there are more of them going down than coming up. And so you're already ahead of your benchmark and your competitors, and you haven't even started work yet. So ultra high growth stocks simply aren't worth the effort. And so this slide then brings us on to the next question, profits. Should tech companies be profitable? And so here on this slide, we have the 4 things that we're looking for in a company. The first one is we want a strong underlying technology trend that's helping the company. The second one is the company has to be able to create value from that trend. The third one is we need barriers to entry or someone will steal the value away. And the fourth point, once that value is being created, who does it belong to? Does a reasonable proportion belong to outside investors because they're our clients? And as you'll recognize, this is just the most boring list. Everybody is looking for this list. Every investor wants these 4 things in a stock, apart from in the tech sector. And tech investors are only interested in number 1 and number 3. So tech investors are obsessed with top line growth, number 1, and then with competitive strength, the products, number 3, the barriers to entry. And they don't think that value creation is particularly important. It can always be postponed, preferably until we've totally eliminated the competition. And number 4, who owns the value once it's been created, is not even recognized as a question in the tech sector. So everything to do with number 4 ends up in the pro forma adjustment to earnings and EPS so that we can forget about it. And this is extremely strange because the rules of tech investing are exactly the same as in every other sector. And we're following them because we are quite traditional investors, but we are virtually alone. No one in the sector is interested in 2 of these 4 rules. So why is it that technology investors are ignoring half of the questions they need to ask about their investments? And the answer is it's a fundamental misunderstanding as to what the job of a technology investor is. So people think that the job of a technology investor is to invest in technology, but it's not. The job of a technology investor is to invest in technology companies. And a company has to create value for its outside investors at some point in its history, or it's worth nothing. It was never worth anything, and it never will be worth anything. Now, you might be lucky enough to sell the shares to someone for more than you paid, but that is a matter of luck. It's very difficult to do it consistently. So we would much rather take our investors' money and actually buy something that's worth something. But that is very different from our competition, who don't seem to think that consideration is even slightly important, which is quite extraordinary because they're doing this with other people's money. They're investing, in inverted commas, investing other people's money in things that aren't fundamentally worth anything at all. And personally, I think that's absolutely disgusting. So number 4, where does this value go if it's not belonging to the outside investors, who after all are the owners of the company? On this slide, you can see the 5 places that the value disappears to. So the first one is stock comp. So this is a huge issue in and around San Francisco and Silicon Valley, in particular stock options. So we tech investors have been trained to believe that stock options have no cost to us. That's clearly absolutely ludicrous, but that's what we believe. So tech investors take everything to do with stock compensation and stick it into the pro forma adjustment so that we can ignore it. But engineers working for these businesses love options because they know that that's the only way they're going to get rich without setting up their own businesses, and which is scary, so they don't want to do it. So they'll never be billionaires through stock options, but they might, if they're lucky, become multimillionaires. So they like options. And we are telling management options are costless, so you can give away as many as you like, we'll just ignore it. And then you have to think about which of these 2 groups is the scarce resource, investors or engineers. So investors are not the scarce resource. There are millions of us, there are trillions of dollars trying to get into these companies. In contrast, there are 2 scarce resources currently in technology. One of them is battery power, and the other one is cloud software engineers. Basically, if you're a good engineer in and around Silicon Valley, you can be paid whatever you like, as long as you're being paid in options, because no one's counting. We are telling management to retain good staff when staff are scarce, in huge demand, and we're telling them they can use as many options as they like to do so. So what do? They give away all the options they need, and that is turning San Francisco into the most expensive place to live in the world. And it's being made as expensive as that with our clients' money, and I don't think that's right. Now the second one is acquisitions. So software acquisitions can create quite a lot of value in tech, and there are tech acquisitions that do create value, but most don't. Most destroy value for the buyers. And the reason is you have to think about why companies are making acquisitions. They acquire other businesses because they lack something. Let's say they lack geographic spread, they lack a particular skill set or group of staff, they lack a technology, intellectual property, or they simply lack growth. And so what they're needing to do is go out into the open market and buy what it is that they lack. And if in the open market you're buying something that you need and don't have, you have to pay more than everybody else. So almost by definition, you are overpaying for what you're buying. And in technology, it is even worse because, as we all know, in the tech sector, no one pays any attention to valuation at all. So the companies doing the buying basically have no constraints on what they pay because no one's even going to question it. So therefore, everything they do is overpriced. So acquisitions are almost always overpriced. The third point is lack of accountability. So this is non-voting and super-voting shares and self-appointing boards and the like, for example, at Alibaba. So you just got to be aware this company is not being run in the interests of outside shareholders, our clients. It's being run in the interest of management. Those interests may align occasionally if you're lucky, but you just need to remember this. The object of this business is not to make our clients wealthier. Then number 4, lack of business focus. We touched on growth. A company that is being run to maximize growth is not being run to create value. But also the second one's technology leadership. So this is particularly where the engineer who founded the company is still running it. Engineers are amazing people, and thank God they exist, because we'd still be living in caves otherwise. But they think differently about businesses to the rest of us. So the object of a business for an engineer is not to create value. The object of a business is to create the best possible product. The product that his or her friends admire, preferably that they use and tell him or her how good they are. And his friends are also engineers. So these products tend to be over-engineered. R&D budgets bloat. Products tend to become endless iterations and perfections of existing products. And that is not the way to run a business to create value. It's a very different object in running a business. And then the fifth point is restructuring, and this is an issue throughout the market. Here you have a profitable company, and every couple of years, every 2 or 3 years, it has a big restructuring expense. And management tell us to ignore that because it's a one-off. Well, if it's every other year, it's not a one-off, it's just a cost of doing business. So in each of these cases, either there isn't any value being created after all, or there's less value than we think, or there is value that's being created, but it's not going to the outside investors, it's going to insiders or the sellers of acquired companies. And it's lovely, it's very easy to find these because all of these appear in the same place. They all appear in the pro forma adjustment to earnings and EPS. So if we want to see what the problem, the fundamental flaw where the company's business model is, you go to look at the pro forma adjustment because that's where the embarrassing stuff is put so we don't have to think about it. We now move on to the final point, size. So as I said at the beginning, I believe a mega cap is a company with a market cap of more than 1% of the S&P 500. So that's currently around $300 billion. And this slide shows you the 7 mega caps in the tech sector globally as at the end of June 2020. So if you owned a passive global tech fund, almost half of your capital was tied up in these 7 mega caps. If you owned a US tech fund, it would have been more than half because the top 5 US tech stocks dominate S&P tech. But if you owned an active tech fund, you also probably own the stocks on the right. Alphabet, Facebook, Tencent, Amazon and Alibaba are not tech stocks. They're communications or consumer stocks. And yet people expect to see them in portfolios, in tech portfolios. And tech fund managers therefore oblige. And these are very big benchmark weights. So from their point of view, it's risky not to have the names on the left in their portfolios. And they're expected to have the ones on the right. So they will tend to have most, sometimes all of these 12 names in their portfolio. So active tech funds can have more than half, possibly even 70% of the fund invested in the tech mega caps. And you just got to ask, why on earth would you want to do that? Because that's just stupid. Because these companies are the winners of the last round of disruption. And the history of the tech sector is very clear. The winners of the last round of disruption are collectively the losers of the next round. So what you have is a portfolio with more than half of the capital devoted to the losers of the next round of disruption. And that really doesn't sound very clever to me. So we don't care about the benchmark weight. We don't feel the need to own any of these stocks if we don't want to. We start with none of them. And then we buy the 3 or 4 of them where we have a really high conviction they are going to be dramatically better companies in 5 years than they are today. And that is a very, very high bar indeed, because these are amazing businesses. These are the best business models the world has ever seen. But if they're going to outperform the tech index and the tech industry, they have got to become dramatically better. So if Apple is just the same as it is now, but quite a lot bigger, it will have underperformed the tech index in that time. It's got to become a better business to outperform. And it's very difficult for these companies to do that. So don't expect to see more than 3 of these 12 names in our top 10. And that immediately makes us look different from almost every other large cap tech fund, because they are dominated by these 12 names. They'll have 6 to 8 of these names in their top 10. So on the next slide, you'll see what our portfolio looked like at the same time. So we do have 2 mega caps in there. Microsoft and Taiwan Semi-conductor are both enormous companies. But we can tell you quite clearly why we think they are going to be dramatically better businesses in 5 years than they are today. And the other names are all large cap. So some of them will be quite familiar names, and they feature in other tech funds, and they feature in general portfolios as well. But you don't normally get 8 of them in the top 10. And what is not on this list? So we don't have Apple, Facebook, Amazon, Google, Tencent, Alibaba, Intel. These stocks are not on that top 10 list. There are only 2 mega caps now, Microsoft and Taiwan Semi, and the rest of those are large caps and sometimes even a mid cap, because we're not really very interested in the market cap. As long as it's liquid enough for us, we'll own it, and we could own quite a lot of it if it seems appropriate. So our top 10 is fundamentally different from everybody else's. It's not dominated by those 12 tech-related mega caps. So we instead are focusing on this $10 billion to $100 billion range. So we don't go below $1 billion. That's small cap investing. That's very different. We don't do much below 10. But a $10 billion company is a very, very big business indeed. It's got all the liquidity you can need. It's got all the information you might need. It's probably got an IR department that talks English, which is jolly useful. But if it gets it right, it could become a mega cap. So that's an increase in valuation to $300 billion or more, an increase in value by 30 times. If you think about the very biggest companies, Apple is already a $2 trillion company. If it's going to just double from here, that's a $4 trillion company. Is there enough money in the market in S&P investing to support a $4 trillion stock? And that will be a bigger portion of the S&P than has ever been seen before. So it seems unlikely. But these $10 to $100 billion stocks have got all the advantages of liquidity and information, but they have the potential for huge upside if they get it right. So they are the sweet spot of the industry. And we don't think anyone else is focusing on this group. So these stocks are owned by people, but everybody else seems to focus on the very largest or the very smallest companies, and not on the best bit of the market, which is the $10 to $100 billion cap range, which is typically more than half of our fund. How do we weight these stocks? So we typically have 30 to 35 names, and when we buy them, we rate them A to E, and an A typically is a 5% weight, and an E is a 1% weight, and those ratings and weights don't change. They very seldom change. So that long-term target weight remains the same for many, many years. But at any moment, it might be a B plus or a D double minus. And those pluses and minuses are the short-term adjustments to that long-term target weight. And what we're doing here is differentiating between risk and volatility. So BlackRock will tell you that risk and volatility are the same thing. Because from BlackRock's point of view, they are. They're both the chance that I, the portfolio manager, have a really bad quarter, and you, the client, will remember that bad quarter a lot longer than you remember any of my good ones. So for BlackRock, risk and volatility are both bad. They are the same thing. But for us, they are completely different. So I would see risk as the chance that what I thought was a long-term positive trend is actually negative. So I've just misunderstood the future for this company. I've got it wrong. Risk, I don't like at all. That's bad. If I don't understand what's going on, or if it looks like it's getting riskier, it's gone. It's not in the portfolio anymore. But volatility, in contrast, is the natural fluctuation of a stock price around a long-term trend. And if that trend is positive, then volatility is fantastic. Because not only do I get the upside over time from that positive trend, but I can also trade against that volatility and multiply that upside. And that does make quite a considerable difference to our performance. So we add value by trading against that volatility. If a stock does really well, we don't tend to sell it. We just take a lot of the money out. So we take it back to a weight well below its long-term target. Then if it goes sideways or underperforms for a while, then we'll look at it and see, are we looking at volatility or are we looking at risk? So if it's risk and the business model's broken or we don't know what's going on, then we'll sell the stock. But if it's just natural news flow and we don't think there's any change to the long-term story, then we'll add to it. We'll take it to well above its long-term target weight. And so we're constantly trading against that volatility and adding to risk, adding to value on what was already a long-term positive trend. And none of this depends upon benchmark weights, which are totally and utterly irrelevant. So this slide shows that we've come to the end of our list of 5 items. And the result on the following slide, you've seen most of this before. First quartile of technology funds in 2019, 2020 and 2021. Second percentile for the 3 years to the end of December 2021. First decile for the 3 years from inception and to the end of August. And a 30% annualized net return since launch. Over 5 years, actually, it's been more than 30% as well. But that 17.8%, the mid-high teens annualized net return over the last 10 years is much more representative of the long-term return that we have achieved and we expect to continue to achieve from this strategy. And that's how we got to AUM in excess of 1.1 billion within 4 years of launch. So that essentially is the presentation. Thank you very much for your time. If you have any questions or you want to get hold of us, do email us or find us at www